Listed private equity provides the opportunity for a broad range of investors to access private equity as an asset class. Now, private equity historically has outperformed public markets, net of all costs. So as a portfolio diversifier to boost returns, private equity is invaluable. Now, most investors are unable to access private equity because it's traditionally an institutional asset class. Listed private equity opens that up to a much broader range of investors. Some of the exciting and well-known companies that we have backed at a fairly early stage, Airbnb, Uber, Snapchat, Just Eat, those are the kind of better known examples. I'd say alongside those, there's a whole host of companies that nobody has really heard of that may still be relatively early stage, that are the next generation. So they're exploiting technologies that the general public are not even aware of right now. Listed private equity could fit really in one of two places within a standard portfolio model. It could fit into equities. It does share some of the characteristics of public equity, similar overall risk level, but also some investors look at it as an alternative, so it sits alongside property, infrastructure and hedge funds in that sort of area. So investing in private companies gives you access to a whole new range of opportunities that you won't have access to in the public markets. If you look at the figures on the number of private companies versus listed companies, it's actually quite surprising. So in the US and Europe, even if you cut off at a minimum $10 million annual revenue, there are at least 40 times as many private companies as there are public. The main risks, I suppose, are related to illiquidity. Although listed private equity funds have daily liquidity, the underlying portfolio is relatively illiquid. And we're making, in our case, commitments for 10 plus years at the underlying portfolio level. So investors need to be aware that the time frame over which they should be considering the investment is multi-year, preferably around the 10-year horizon. Our investment approach is very much to take a diversified view. So we invest globally. We have just over half of our assets in the US, just under a quarter in Europe, and the remainder in Asia and rest of the world. So we're providing very broad exposure, not only by geography, but also across different stages of the private equity cycle. So if you're looking at early stage venture, growth equity, buyouts, they're all in our portfolio. Similarly, we look at the market through three different lenses: primary, secondary, and direct. So firstly, with primaries, we're going into funds that are in the market today, new funds that are being raised. In secondaries, we're looking at purchasing mature portfolios at a later stage. And in terms of direct funds, we're going alongside other private equity managers into the operating company itself. Across all of those three kind of different viewpoints, we're diversifying the portfolio significantly to optimize returns whilst minimizing risk to the investor. One example of how we kind of look at the portfolio is across the kind of geographical view. So in recent years, we've shifted our exposure further towards Asia and rest of world. Chinese venture has grown very rapidly in particular. So that has gone from kind of low single-digit percentage of the global market to today upwards of 30%, with many of the new billion-dollar plus companies coming out of China, as well as Silicon Valley. Over the short term, we've performed very strongly. I mean, we're typically delivering double-digit NAV growth in US dollars annually. Over the long term, if you look over the whole period since the IPO, which is now coming up to 11 years, the compound growth rate is hovering around the 8% level in US dollars. Now, don't forget that includes the financial crisis, so it's a strong performance overall. And it does represent an outperformance of 3 percentage points versus the FTSE All-World. HVP's current discount to its peers, I think, is driven partly by sentiment, partly by the fact that HVP is a relatively new entrant into the listed private equity market. Naturally, we're frustrated because our returns have been market leading, particularly over the long term. So we think that perhaps the market is not giving us the credit that we might deserve for that sort of strong performance. So one of the key themes that we've seen in recent years, of course, is disruption of established businesses by new entrants driven by technology, but also by new ways of working. So holding HVP gives you the benefit of the upside from new disruptive companies that may actually be threatening the more established corporate environment, so the FTSE 100, the S&P 500. So in some ways it protects the portfolio against the downside risk of holding those established businesses.